Hey everyone, Bryan Baylon here, your local Phoenix Realtor. Another video today, but before we get started, please like, comment, subscribe. Your support is greatly appreciated, and we're going to get right into it. So today's topic is renting versus buying. So if you're in the market for a home, you may have considered buying. You look at the prices, you think it's way expensive. I'm just going to rent for now until the market goes down. This video is for you, or if you're just interested in buying a home and you're renting right now, this is going to be some really good information for you to chew on. So if you're going to rent, so what do you consider in renting? Basically, it's pretty simple. If you're going to rent a single family home, a 3-2, 3-bedroom, 2-bath, just a starter home, it's going to cost you about $1,500 a month, and that's on the low end. I'm going to use that $1,500 a month figure just to be really conservative. But over time, you can expect rents, especially in Arizona and the greater Phoenix area, to appreciate about 3 to 4% a year. So $1,500 right now is going to get you just into a single family home. $1,300 to $1,500 really is that entry point, but we'll use $1,500 for now. So assume that you change a house every 3 years. Maybe you go into an apartment, or you're going to go into a different house. So you're going to move 10 times in 30 years. So that'll be about $30,000 in deposits. And that's just assuming 2 times your monthly rent for a deposit. So I put 30,000 there, and I'm assuming no increase in rent. So we're going to leave it at 1,500, which especially in 5 years is not going to be true, especially in 15, 20, right? And no maintenance fees. So that is an advantage. If you don't want to deal with the maintenance, the hassle of repairs or an AC or a roof, you can avoid that in a rental situation. Total cost for 30 years. Renting is going to cost you $570,000. It looks like a lot of money, and it is, but just know that at the end of 30 years, you've spent $570,000 towards somebody else's mortgage, and you have no assets, and you have accumulated no equity of your own. Then again, you don't have liability, right? So you've taken that away, but you're coming out with having spent $570,000. So that's on the rent side. On the buy side, if you're considering buying, right now you can buy a single family home, starter home in some places, right? And this is sort of on the low end too, but I do have clients right now that are buying around there. They're getting to around 300,000 plus, right? 300 to 350. They're out the door price because they're getting options and things like that. 275, or you can get a resale home for 275. But I'm gonna use 275 single family home and assume 5% down. You can do 5% down now. At the time this is being recorded, it's May 2020. So there are stronger stipulations for applying for a loan than before the stay-at-home orders and all of COVID-19 stuff happened. But you can still get a loan for 5%. I have clients that are currently putting 5% down on their homes, and that's going to be $13,750, assuming a purchase price of $275. So with PITI, so that's usually the acronym for principal, interest, taxes, and insurance. Of course, private mortgage insurance isn't included in there, and HOA is not included in there. But for PITI, you have HOA and then PMI, private mortgage insurance. Your monthly expense on that's going to be $1,528.23 a month. So if I took $1,500 here, which isn't fixed, right, which is a 3 or 4% increase per year, unless you have a really good landlord. There are good landlords out there that could hold your rent if you're a really good tenant. It just depends. But for the most part, they're running a business in a sense as they're investing, so they want to get their return. 3 to 4% is the inflation rate, so they're going to want to charge you that in their best interest. But this is fixed, 15, 28, 23 for the most part, right? So your taxes could go up, insurance could go up if you claim, but for pretty much your principal and interest is going to remain the same, and you're going to have an entire schedule for the 360 months or the 30 years of how much you're going to pay per month toward interest and principal. And it's usually uploaded in the front end with interest, and then you're paying more of your principal towards the end of your loan. But $1,528 compared to about $1,500 here, right? So just wanted you guys to notice that. PMI, your private mortgage insurance, if you don't have equity, let's say you only have, so 80% loan to value ratio is what they want to see, meaning you have 20% equity in your home. If you don't have 20% equity, you put 5% down, then you're going to have private mortgage insurance, which is additional insurance on that equity piece, that 20% there. So So basically, you'll have PMI. It can drop off if you get over 20% equity in your home. You can refinance, or sometimes your lender will just drop it off. You can also prepay your PMI as well, and then I've had a client right now who's paid down their PMI. They put $4,400 down in their closing costs, and it took off PMI. So there are options. And if it's conventional, it could drop off. If it's an FHA loan, it will not drop off for the life of the loan. So you'll need to refinance, which is additional cost. So if you can get a conventional loan, it's better. If you want to get into a house right now, FHA is okay too. Just know that you'll need to refinance later if you want PMI to drop off. Maintenance. So that's another thing. So rental, you don't have any maintenance. Buying a house, you do have maintenance. And just want to give you guys the scope of what you're going to be doing. I mean, really the major four are electrical, plumbing, roof, AC, right? So I sort of broke down, I could break down those costs, probably be in another video, but right now just use the 1% rule for maintenance. So assume it's a $275,000 home, take 1% of that purchase price, which is $2,750, and save that towards repairs. Which is around, the estimate right now, about $250 a month or something like that. It's better, and this is a good point to talk about this, is if you buy a newer build, you're going to have less costs up front in terms of maintenance, and then later on you'll start to see, obviously, as it ages with use, wear and tear, that you're going to need to maintain that property. But if you start with a new build, then perhaps the first 10 years, because most new builds have 10% or 10-year coverage, structural, and then they have warranties, 1 year, sometimes 2 years for plumbing and electrical, stuff like that. So plus it's a new build, so things are going to be new in that property. You'll be able to defer, in a sense, those payments for maintenance later on. But you're going to want to say that use a 1% rule for yourself. So what's a breakdown over 30 years? So for principal and interest, the total cost of your home on a $275,000 home at 3.5% is what I use, 3.5% interest, $422,000. Your maintenance, using that 1% rule, from $275 or $2,750 a year, is going to be $82,500 over 30 years in maintenance costs. So what you have is you have your roof, which last standard in Phoenix is about 15 years for a roof. AC is about 12. You can get more out of it if you maintain it really well. For the most part, you can expect 15 years roof, 12 years AC, which means you're doing a roof twice in 30 years. And then after 36 years, you're doing it your AC 3 times. So I used 3 anyway. I just took the AC. I used 3 replacements at $8,000 each, and then roped it all in. $82,500 is what your maintenance cost will be. And then taxes would be $70K in taxes. So of course, property taxes, as property values increase, your taxes will increase. So I just went conservative, and this figure's going to come out to $70,000 over 30 years. Your HOA, assuming $55 a month in HOA, will come out to $19,800. And then your PMI, if you buy down or if you just paid and get to 20% equity, about $4,500. So your total cost of home ownership is $599,126. So compared to when you're renting at $570, you think, okay, well maybe I'm saving 30 grand. But here's the difference. The difference is you own this asset. Here, at the end of 30 years, you don't have anything. And when you own this asset and it's paid off in 30 years, assuming you do not refinance or take a HELOC or anything, borrow against the home at all, then at an annual appreciation rate of only 3%, and that's, I use 3% as a very conservative figure. I mean, in 2019, all areas and types, the appreciation rate was 11%. And the year before that was very close to double digits. It was around 8 or 9%. So, and of course, those are sellers markets, right? Appreciating years. There's going to be down years. There's going to be recessions. But for the most part, you can expect over a period of time, 30 years, annual percent appreciation rate of 3%. Your home value, when you bought it, $275,000, in 30 years, your house is going to be worth $667,497, estimated, of course. You might think, well, how did it get from 275 to 667? Well, I'll tell you, a client of mine bought a new build in 1991. They bought it for $106,000. starter home, 1,900 square feet, 4-bedroom, 2-bath, base. Just basic patio, basic appliance, like everything's basic. They didn't even have appliances. They just had the basic cabinets. The flooring was carpet. I mean, just think base. $106,000 in 1991. Don't you wish you could buy a house for $106,000 now, new build? That'd be amazing. But that's what it was in 1991. They listed it in February of 2019 for $370,000, and they got full price on their home, and they sold it for $370K. So they bought it 29 years ago for $106,000. They sold it for $370,000 in 30 years. So from 106 to 370, 275 to 667 is not lofty at all. And at the end of your 30 years, after having paid your $599, assuming you wait the 30 years, you could pay it off early, right? You could do a 15-year. You could pay down towards the principal $100 or $200 more. If you do $200 more in your principal from day one, right, from your first mortgage payment, you could cut off 7 years in your payments or in your loan. So you have an asset of over $500,000 at the end. So if you look at the value, I mean, you think here, not much risk, I just pay and I don't have to worry about anything, which you do, because sometimes your landlord's not going to cooperate with you with rental, first of all, your payments, in terms of them increasing your rate or maintenance. I mean, you could have, unless you want to pay it yourself, you're going to have to wait for your landlord to, work with you on that. Here, yes, you upfront the costs. Yes, it does cost more money throughout the life and more possible work, right? For having to maintain your home or deal with some issues with your home. But at the end of that, you come out with the asset. So, I would recommend, if you can buy, to buy because you're investing into your future. And, if doing the numbers here, you can see that for yourself. So hope this has been helpful for you. If you have any questions, feel free to reach out. In the description below is my contact information. And I hope you guys are having a good one, and we'll catch you guys next video.